Okay, good evening, everybody. Thank you for coming. My name is Ira Joseph. I'm a fellow at the Center for Global Energy Policy here at Columbia University, and my day job is I'm Global Head of Gas and Power Analytics at S&P Global Platts. Tonight we're going to have a talk tonight about the IEA's Gas 2018 Medium-Term Market Report and the 2018 Global Gas Security Review with a set of distinguished experts whom I'm going to introduce in a moment here. Gas 2018, the latest IEA annual market report, examines the evolution of global gas markets in the next 5 years and provides a detailed analysis of supply and trade developments, infrastructure investments, and demand growth forecasts through 2023, which is what we largely consider the medium term in our business. Global Gas Security Review offers an extensive assessment of recent gas balancing issues and related policy developments linked to security of supply, as well as lessons learned from recent events. Let me first quickly say that this event, like all of the events at this center, is being webcast live, and both the full video and podcast recording will be available on our website and iTunes in the coming days. And for those of you watching online, as well as people here in the audience, you can ask a question for the panelists at any time using hashtag CGEPevents and our Twitter handle at Columbia U Energy. So first of all, I want to introduce our speakers today. We have the two people here who will be commenting today are Leslie Palti-Guzman and Akos Loj. Leslie is the founder and president of Gas Vista, which is a global gas consultancy. She's also a senior advisor at Rapid Energy Group. And Leslie has spent more than 10 years of experience in the business in terms of market research and as a journalist and as a political risk advisor. Akos works here. He has co-authored several publication journals, including Foreign Affairs, Oxford Energy Forum, and Horizon, and has contributed to the Policy Institute's major research reports on global gas market implications for American LNG experts and on the implications of lifting the crude oil export ban. And then getting to our featured speaker today, which is Jean-Baptiste Dubreuil, who is the senior natural gas analyst at the International Energy Agency, and he'll be discussing the report. We'll have Jean-Baptiste speak first, and then Akos and Leslie will comment on that. I'm going to ask a few questions, and then, of course, we'll take questions from the audience as well. So, Jean-Baptiste, why don't you step up and give us your 5-year outlook and security review outlook. Thank you very much.
Thanks a lot, Ira. Good evening, ladies and gentlemen. It's a pleasure to be among you today to guide you through the main findings from our most recent global gas security and 5-year outlook to natural gas markets. I'd like to thank Columbia University Center on Global Energy Policy for hosting this event. So, natural gas markets are growing at a quite steady pace, and we've seen last year, 2017, 3% growth globally. But this is not a one-off, and the first figures that we have from this year would confirm this trend, and even to some extent would outpace the growth that we have seen last year, depending on what comes for the coming winter. Looking forward, we assume at the IEA for the next 5 years that the global gas markets will be shaped by 3 main factors. The first one is the strong development of gas demand in emerging Asian markets, led by China on the back of strong economic growth and a strong policy push to improve air quality, which will be followed by all the major emerging economies in South and Southeast Asia. The second one, on the supply side, is the emergence of the United States as a major LNG supplier, which we believe will account for 40% of production growth in the next 5 years and up to 75% in LNG export capacity. The third one, a bit more technical, but also of great importance, is a shift in terms of consumption patterns from power generation, which used to be the main source of natural gas growth around the world, to industry, both for traditional, processes, but also from non-energy users in petrochemicals and fertilizers. So all in all, the bottom line of our forecast is that we see a quite positive outlook for the natural gas markets in the 5 years to come. But this growth is not without challenges. Those challenges are different natures, commercial, first and for all, because in most of those new emerging markets, the price competitiveness of natural gas will be a key issue to make sure that the growth that we see will be sustainable. In terms of environmental sustainability also, the industry has to make sure that its environmental footprint will keep on improving to ensure the long-term sustainability of gas growth. And in terms of security, which is one of the main themes of this presentation, new market also means new security issues. So, to set the scene before talking about security issues, setting the scene for the growth in the next 5 years. Well, on the demand side, the picture is dominated by China. We do assume that China will account for almost 40% of global gas demand growth in the next 5 years, and that China will become, probably as soon as this year, the world's biggest natural gas importer, both in terms of LNG and pipeline imports. You can see on that chart that China is not, of course, alone in this contribution to global gas growth. Other regions also contribute to a sizable amount to this, both producing regions, such as the Middle East and North America, also importing regions, such as the rest of emerging Asia, amongst which India, Africa, Latin America. On the supply side, contributions will come from various regions, the most important one being North America and, of course, the United States. As I said earlier, we anticipate that US production will account for 40% of global production growth in the next 5 years. But in most of the cases you have on this graph, additional production will be aiming for domestic markets. So if we narrow the picture to export capacity, there will be mainly a trio of main exporters to grow in the next 5 years. That are the United States, Australia, and Russia. And the United States is expected to account for 75% of LNG growth. So LNG will be the key driver to the expansion of natural gas trade in the next 5 years. If we have a closer look on a regional breakdown, Atlantic Basin and the Middle East is expected to remain stable, apart from some increases in Europe, mainly to compensate for the decrease of domestic production. Major mature Asian importers, that are Japan and Korea, are expected to remain stable. And most of the growth will come from emerging importers. China, of course, and other South and Southeast Asian markets. Altogether, the global energy market is expected to pass the 500 BCM mark before 2023. So this is for the global picture. So the market is changing at a very fast pace, but it also has some structural implication in terms of how we define security of supply. And a good example was a review of the events that occurred over the last winter. The strong growth of Chinese natural gas demand last year caused some supply shortfalls in the past winter. This prompted a series of reactions from the Chinese administration, including new supply contracts to develop and diversify China's natural gas portfolio, investment decision to develop the country's infrastructure with new pipelines, regasification terminals, and underground storage capacity, and also new policy guidelines for natural gas medium-term targets and priority areas to the deployment and win the battle for blue skies. At the same time, in Europe, over the last winter, several cold spells and unplanned supply reduction occurred, but no supply shortage were observed for the main users. These showed the resilience of the integrated European natural gas system, highlighting the importance of implementing coordination policies, the role of network integration, and cooperation between network operators. Flexibility in LNG trade has improved over the recent past with a growing share of destination-free contracts. So, alongside with the traditional back-to-back long-term agreements between exporters and end users and utilities, some of the largest buyers have developed an integrated portfolio approach which enables them to benefit from the multiple sources of long-term supply to resell LNG to end users with smaller volumes and smaller durations, either to traditional buyers, to new entrants, directly, or through the intermediation of commodity traders. The development of this secondary LNG market in parallel with the traditional back-to-back agreements has been made possible thanks to the development of long-term contracts flexibility. So one of the key metrics that we follow in the Global Gas Security Report is the evolution of contractual flexibility year on year. And for this third edition of the report, we have seen some changes in the patterns of flexibility that you have there according to different metrics: time flexibility, share of short-term volumes, average duration of contracts, and destination flexibility with the share of destination-free volumes. Time flexibility has not shown a very clear pattern so far in terms of development of the short-term trade, whereas the average contract duration has dropped significantly since 2014, and the share of destination-free volumes show a growing trend. For contracts signed last year, in 2017, we see a strong growth of short-term contracts with smaller volumes, but also a rebound in fixed destination contracts for those shorter-term volumes. This is connected with the development of LNG secondary markets that were highlighted in the previous slide. In terms of price indexation, gas-to-gas indexation is becoming more common in new contracts, but oil indexation remains the major component in price determination, especially for Asia and Pacific region. The risk of a tighter crude oil market, together with seasonal tensions in LNG markets, put additional pressure on LNG prices. One topic that we have looked in this year's edition of the report is the timeliness of LNG supply to cope with unplanned short-term supply issues. LNG plays a growing role in providing flexibility and security of supply to those new markets. Yet the time it takes to ship or redirect cargoes of LNG limits its practical effectiveness in addressing an unplanned supply shortfall. In these regions, it takes at least 3 days to receive and regasify an unplanned additional LNG cargo if all sources of LNG can be diverted In reality, it is mainly uncontracted or flexible LNG which can be diverted, which takes a longer time, up to 6 days in the case of South American West Coast, for instance. Hence, spot and flexible LNG has to be considered as part of a broader range of tools, including network integration, storage development, fuel switching capability in power generation, and demand response measures to be able to cope with unplanned supply shortages. The regions that you have over there are mature regions and have already implemented such tools. But new importers are more exposed to this timeliness issue. A last point I would like to emphasize on the new challenges for flexibility and security of supply for the LNG markets is the availability of shipping capacity on the market. To be honest with you, when we started thinking about the themes for this security report a year ago, shipping was on the bottom list of security issues. The market was long, and all the market players we discussed with were desperately looking for opportunities to place their cargoes. But recent changes in the LNG market have challenged the fundamental ways that the shipping business is operating. The wave of liquefaction projects that we have seen in the past years also triggered many vessel deliveries alongside with those projects, which peaked this year in terms of new deliveries. This resulted in a glut of shipping capacity 2 years ago in 2016. However, looking forward, if we take into account the current stock of vessels and the orders already placed as of today, we see that this capacity is shrinking at a very quick pace, and that LNG carrier fleet availability would pose a problem to global LNG market global LNG market development, security of supply, earlier than new liquefaction capacity availability would do. Under a more volatile and flexible business environment, the shipping industry must find new ways of mitigating credit risk to incentivize shipping investment. As you see, we do anticipate globally that we will have, all things being equal as of today, negative capacity by 2023, but as soon as 2020 will be below 10% of availability, which is more or less what was the case in 2013. So what are the practical consequences? This is a practical illustration of the impact on charter rates. We come from a very long shipping market in 2016, with prices bottoming around $30,000 per day for spot rates, to the current almost record levels at 130,000 for the Atlantic Basin and 140 for the Pacific Basin last week. The rise in fuel prices is, of course, a major component in that rise, but as you can see on the chart with the blue curve, the recent spike is disconnected to the fuel prices rise and mainly owes to the fundamentals of the shipping industry itself. So to conclude this brief outlook and security presentation, I'd just like to say that recent events show new challenges for security of gas supply from this very fast changing market. The IEA, as a major partner to both producing and consuming economies, pursues its mandate on gas security by improving transparency, encouraging flexibility, and supporting greater market resilience. Thank you very much.
we're going to have two commentaries first. We'll have Leslie start and then Akos follow, and then we'll begin to mix in some questions. Thank you, Jean-Baptiste. Very interesting and very clever presentation. It was a good mix of stuff, and I myself have a lot of questions for you that I'm very excited to ask. So we'll start with Leslie.
Good. Hello, everybody. So thank you very much, Jean-Baptiste, for the presentation. It's very interesting, and I agree with many things that you've been saying. I think we'll go back in the Q&A and also with the questions from around the demand, supply, and other dimension of the market. But I wanted to comment a little bit on your comment on the shipping side, and I think it's very important what the International Energy Agency is doing on pointing to the industry that shipping is a critical component of the industry, and it's often the overlooked and forgotten component in the industry, but it's critical in the value chain to bring the supply to the destination. And but I would like maybe to bring to the attention a few factors that could mitigate this uneasiness with the tightness on the shipping side. So one is that the shipping industry is very cyclical. So as you mentioned, we were before in a tight, in an oversupply market. Now we may turn again into a tight market, but maybe we will be, earlier than anticipating again in a long market. And traditionally, the shipping industry has been very bad at matching the timing of delivery of the ships with the timing of the new supply coming into the market. So it's really hard for analysts to, because of the lead construction time of those ships, to really see when are those going to be available. But I agree, if we look at the order book, there is maybe a shortage upcoming. The other point that I would like to make is that there is a growing trend of intra-regional trade compared to inter-regional trade, meaning that the ships may travel shorter distance because instead of coming and crossing different oceans and basin, they will remain in the Pacific. So Australia to China, Australia to Japan, rather than coming from the Atlantic basin. So the way to optimize the ships with a growing trend of inter-regional trade is changing also. Another point that you've been making is, flagging this increase in the shipping rates and tanker rates. So in turn, that creates mitigation strategy from the big companies, and they want to optimize even better their fleet and really think hard about saving costs. So I think they will also be a critical players in trying to mitigate this trend. And the other factor is the seasonality. And so depending on the seasons, we see convergence of pricing between the Atlantic basin and the Pacific basin, especially during shoulder months, springtime, for instance. So that reduces also the number of cargoes, for instance, going from the US to Asia. Because the pricing arbitrage is not good enough, so they go to Europe instead. So it's shorter travels, shorter distance for the ships, so less, more available ships overall in the market. So that's, a few factors to think about just to mitigate this idea of tightness in the shipping market. And I'll keep my other comments for the rest of the discussion.
Thank you. I'm a huge fan of IEA reports, so I usually find very little to disagree with, but let me just try to throw out a few points perhaps to help our discussion later on. So I again completely agree with Jean-Baptiste that China is the most important country to watch on the demand side, and we are also seeing the measures that China is taking to avoid a repeat of another gas shortage this winter, similar to the one we have seen the last winter. Although there is one thing I think that's important to emphasize. I think China will never have enough seasonal storage capacity, never have as much seasonal storage as the US or Europe, ranging from 15 to 27% of total demand because of the geological constraints and the lack of suitable sites in China. So I think to a certain extent, Chinese demand will always be cyclical, and for lack of a better alternative, I think LNG will always be the primary balancing factor to deal with that seasonal cyclicality, which I think will have important implications for the future market. I also completely agree that the US is currently dominating in the new supply capacity additions. However, I don't think that there is any guarantee that the US will also play such a significant role in the next wave of LNG supply additions. If anything, then politics is hurting more than helping, especially the US-China trade war, which essentially keeps away potential Chinese buyers to sign long-term contracts with new US project developments. So I think there are more questions about the role of the US in the next wave of supply capacity additions. Again, emerging Asia will definitely be an important demand driver going forward. But at the same time, and we have done a study on this, it's devilishly difficult to forecast demand in some of these emerging importers, because it's not really a question of fundamental drivers of demand. We know that the demand is there. If there is someone who can unlock that demand, there are population growth, there is GDP growth in these countries. So it's not a question of demand, but it's your ability to predict that there will be some trading house or some other unconventional players who can step in and essentially bring in an FSRU and unlock demand in a country where otherwise there are huge credit quality and other issues which need to be overcome somehow. So I think the demand in these places is much more uncertain than in a place like China or even Europe. Regarding the portfolio players, I think the emergence and the prominence of portfolio players is indeed a great liquidity and flexibility booster in the market. But at the same time, I was in Japan just about a week ago, and it was interesting to hear from the buyers that they are extremely concerned about concentration of market power in the hands of a few portfolio players. So we are already seeing the market shifting from a buyer's market to a seller's market. And I think from the buyer's perspective, having portfolio players play an even more prominent role in the future might actually mean a seller's market on steroids in the future. So I think I might add one or two points regarding the shipping market, because it's a fascinating market to look at. I mean, as Jean-Baptiste said, charter rates quadrupled or quintupled just in just about a year. So that's definitely an inflection point. There's definitely something important going on in the LNG shipping side. I think it's not just China, not just demand boom that's driving this huge spike in shipping charter rates, but also the structural increase in ton-mile demand. I actually disagree a little bit with Leslie here, because I think as the US LNG supply is coming to the market, I think the US market is generally further away from the typical import market, which is somewhere in Asia. So for 1 million ton coming out of Australia, you typically need one vessel. From the US, you typically need two if it goes through the Panama Canal. And Russia is another component of growing supply. I think from Russia, when it's winter and it has to go all the way around Europe, I think you might actually need three vessels to ship the same amount of LNG than let's say from Australia. So I think these factors are additional to the tremendous demand growth that's coming out of China, and this means that the demand for LNG shipping is actually going faster than just the traded amount of LNG in the market right now.
Yeah, to marry those 2 points that Akos and Leslie were making are important, because because the spreads in prices around the world became so wide in early 2018 and through a lot of 2018, we have seen freight rates or tanker rates become really, really high, particularly in the Pacific. But to Leslie's point, 4 or 5 years from now, as we get more optimization in the market, we're going to see much, much more intra-regional trade happening, and I think that will ease off some of the tension, unless, of course, we get some sort of spike in the market where, you know, we do get a big draw of Atlantic Basin LNG into Asia. So I wanted to ask some structural questions for you based on some of the comments that you made, and I always like to start off with a point that over my 30 years of doing this is an observation I've had that I'll get to the question in a second here, which is that in the 30 years I've been doing this, I've met the vice president of every job you could have at a gas company in the world. And some of you have heard me say this before, so pardon me if you have, but I've met the vice president of exploration, production, supply, origination, and in 30 years I have never met the vice president of gas demand in a gas company, ever. Nobody's ever handed me that card, and it's just something structural about the gas industry that's going to and is already changing and is going to have to change over time, is that we are in a world where the volume is so long on supply, both in terms of what reserves are in the ground and also to monetize that gas in order to create more oil and liquids production, because we don't really want to flare the gas. Creating demand for this gas at an appropriate price is really sort of the tricky part of this market going forward, not just out to 2023, but sort of more in the long term. So that gets me around to the question for you, which is, Jean-Baptiste, which is in the first slide you mentioned that industry has sort of overtaken power generation in terms of gas demand growth, in terms of your short-term structure, which is really interesting to me, because if we were sitting here 10 years ago, we would have said 80, 90% of the gas demand would have come from power generation. So is the issue that we're seeing organic growth on the industrial side, or is it just the demise of growth in gas demand for power generation that's causing this sort of inversion of the two in terms of the priorities for gas demand?
Well, to give it a short answer, I think it's both.
Okay.
To give it a bit of a more longer answer, I think that on the one side, if you're contemplating those emerging markets, in most cases gas is caught in between coal, most cases domestic coal or cheap imported coal, and the promise of the development of renewables, in which it's difficult to compete except if you have very strong needs for flexibility.
Right.
So that's one component. The other one is that the needs for industrial sectors, including non-energy needs, is a key component of the GDP growth of those countries. So industry output grows, and for most of these countries, if I take just a simple example of India, securing supply for fertilizers, which is the cornerstone of agriculture independence and food supply chain, this remains the key pillar of the energy import, the LNG imports of the country. So it's both of them.
Yeah, it's interesting because India, obviously being a net importer of gas, the gas is relatively expensive compared to the U.S., where there's been a big industrial boom because the gas is so cheap. But yet it's happening in both places. I think that's sort of very interesting that it can happen in both of those areas at the same time. Do either of you have any thoughts on this, or?
So on the demand side, I think suppliers have been really proactive at opening new markets, especially with LNG to power. So in very small emerging markets in South Asia, in Africa to a certain extent. But the financing has been the most complicated part of the puzzle. And I think there is a lot to do in this regard regarding public-private partnership in financing those small-scale LNG and LNG to power projects. And I think that's the same in shipping, actually. I think increasingly we'll see more partnership between governments and private companies to alleviate potentially the shortage in the shipping side. India is a very interesting case where LNG demand is driven by policies, a little bit actually like in China. So it's very policy driven. Now India is talking about being a gas-based economy. And of course, coal is king, but beyond power generation, it's the use of gas in cities, and similar to big cities in China, where there is big concerns with local air pollution. In big cities in India, that's the same. But also they are emphasizing connectivity and increased distribution of gas through pipelines. So there are many pipelines under construction, especially in the eastern side of India. And those government-pushed projects are ongoing, but like everything in India, it's bureaucratic and it takes more time. So like the time frame for building those new pipelines is like 8 years, but it's well advanced and it's ongoing. So there will be additional, 174 districts, I think, that will be connected in the next 8 years. And that will mean more gas for cooking, for heating, well, not heating in India, but like cooking for sure, and transportation, road transportation. So, big buses potentially, big trucks, or cars, and industry. So I think, in many countries, actually in Asia and South Asia, we see the growth of city gas, which encompass, different sectors, but it's this idea of switching from another fuel that is more polluting to gas. So in some of the cities, it's LPG, or other fuel, oil-based fuels that are less safe or more polluting than gas.
So that actually is a good segue to my next question, which is that when you look at the 5-year outlook or the medium-term outlook and the long-term outlook, given what happened in China last winter, where there was this major policy-driven change in demand, how do you look at around the world when we look at China versus the Middle East and certainly the U.S., sort of policy-driven demand growth versus price-driven demand growth? I mean, in your model, when you're looking at that, how are you factoring in both of those and how those can change over time?
Well, for mature market economies such as Europe or North America or East Asia, the situation is a bit different if we look from one region to another. In the case of the United States, the availability of abundant and cheap resource clearly drives the growth of natural gas. In the case of Europe, well, we have seen different fortunes for natural gas. First, being pushed in power generation by the development of renewables, but at the same time being encouraged by policy-driven measures such as coal phase-out, nuclear phase-out in different countries, or setting a minimum price for CO2 in the United Kingdom, for instance. So there are different cases. If we take another example, which is Korea, the new administration has set very ambitious targets for nuclear and coal phase-out, which are outlined in the 5-year plan for gas, which was published this year. But this stretches out to 2030. So the first measures will be seen at the end of the 5-year plan.
Okay. Because when we look at, in our work, when we look at sort of a lot of the LNG demand growth areas that you're referring to, a lot of the end use of that LNG, the price is somewhat underwater relative to the import price. And I'm trying to, for myself at least, I'm always trying to think about, does that imply that demand growth will maybe be faster because it's somewhat subsidized to some extent? Or does that mean domestic prices are going to have to be risen and maybe there is some risk of some slowdown because prices will be higher and not necessarily as competitive for industry or even in power generation as they were before? I mean, I'm sure you focus on this, obviously.
Well, this is the big question mark in the outlook, because as you have seen, we foresee a sizable part of the growth coming from emerging Asia outside of China. For China, it's a bit simple to say that it all boils down to policy decision, but it's mainly driven by policy. Mm-hmm. For the other economies, it's true that price sensitivity is much more important. If you take the example of Pakistan, for instance, and at the beginning of this year, a tender was cancelled for LNG cargoes because the prices that were received were above what what could be afforded by the government. And in this case, it's quite straightforward translation in terms of no power generation, because there's no alternatives. So it always has to be related to competitiveness with other sources of supply and ultimately with demand response and no supply.
Any thoughts?
Yeah, I think most of the incremental demand coming from China is policy driven. But I think over the longer term, it's also a question of how price sensitive policies are themselves. So if people keep seeing LNG prices above $10 per MMBTU, maybe eventually the policy push for switching coal to gas might have over time. And as Jean-Baptiste said, in some of these new emerging markets, gas is not necessarily competing against the cheapest fuel, coal, but rather oil or even blackouts, which has huge economic costs. So sometimes the calculus is not a simple coal versus gas price difference, but rather, how you run your economy, whether you want to risk power outages or you want to pay a higher price for your LNG supplies. So I think it's a very complex question. I think it will come down to policymakers and their decisions about sustaining the policy.
It sounds like you're saying there's a very wide band of potential LNG import prices, like delivered prices, depending on obviously not just the competitive aspect of the market in terms of it's competing versus coal or competing versus oil, but there are these other issues, social issues, I guess, for lack of a better word, blackouts that can also be part of the factors that you think about when you're thinking about where the prices are going to be.
I think there is a wide range of price sensitivities out there. So obviously India is famous for being among the most price sensitive markets for LNG imports, and that comes down to the fact that they have abundant domestic core resources, they have idle capacity in their power generation fleet, and that gives them optionality. But in many places we don't have this kind of optionality. So the next best alternative is potentially comes at a much higher cost than even a high LNG price.
Great.
Yeah, of course. Chinese example. Even in a policy-driven context, one of the interesting lessons learned from last winter is how the Chinese administration reallocates the targets in terms of future gas development. It's not only talking about gas versus coal. It's the main objective is to fight against air pollution. So what we've seen in the latest State Council targets, which were published last month, is first that they have set a cap for the share of coal, which was the first one, I guess, in Chinese history. And second is to say that certain sectors which were privileged in terms of substitution as of last winter, such as combined heat and power, will now be switching back for new capacity to clean coal.
Okay.
So it used to be decentralized coal switching to decentralized gas. Those capacity will not be shut down, but new capacity will be provided by centralized clean coal. Whereas gas will be more and more focusing on industry and in transportation also. So it's not only gas versus coal, it's also gas versus oil and all sources of pollution in urban areas.
Depending on the sector,
yes,
of course, and pollution. Interesting. It's very, I always wonder about how to put a price on pollution. We obviously put a price on carbon, but putting a price on the idea of pollution itself is kind of what that premium would be is very interesting. So to get inside of the LNG industry again here, you put up some really good slides here about contracts and the changing nature of LNG contracts. And the thing, I guess the billion-dollar question that sort of any of us who follow these things ask is that the buyers clearly want shorter, more flexible contracts, right? And the sellers want long-term contracts because in a lot of cases, not all cases, they need long-term contracts in order to finance the trains that they're going to build. Where do you see this resolving itself? Like where is the compromise here that's going to get the new capacity built? Obviously, we've had some capacity announcements in just the past 3 weeks between Qatar and Shell Canada. And we want to think about those, whether those are the new standard or whether they're an outlier. But this issue more about the contract, the short versus the long term, and the needs of the buyers versus the needs of the sellers. What do you think about that in terms of how that's going to get resolved longer term?
Well, if we take it from a historical perspective and beyond LNG, usually to get a flexible market and a liquid market, one of the preconditions that works practically is to have too much supply. That's what happened with the oil industry in the 80s. That's what happened in the UK and in the US in the 70s, 80s to deregulate the markets. And this is basically one of the factors which brought those portfolio players a couple of years ago to change their patterns and sell more in the short term. Mm-hmm. That was basically to find some new outlets for their long position that they had secured on the long term in long-term joint ventures with producers. So this doesn't mean that as long as we may enter back into a seller's market, all that short-term capacity will disappear and we'll be back in old-fashioned, long-term, back-to-back contracts. But it's true that availability of supply is one of the key components of that. And of course, the buyer's requirements are not the same as what the sellers wish. And I echo the concern that Akush was mentioning from the buyers, that those major portfolio contract companies are becoming major market share purveyors on the LNG market. To which extent we would say that there would be a risk of a cartel of the major LNG portfolio players, I'm not sure of. I don't think so. I think that those companies have built their portfolio strategies on optimization. So the main objective of those portfolios is to be able to make the most of their supply portfolios. But of course, if we are to enter in a tighter sequence of the market, prices are bound to rise, and it will be more difficult for those new emerging buyers to find cheap LNG, flexible, at a discount.
They don't seem to be too concerned about it right now, for the moment.
For the moment, yes.
For the moment.
For the moment, yes.
When do they need to start getting concerned?
If I may
Go ahead.
comment on this portfolio player controlling most of the market, I think there are two main risks. The first one is that they become the spot market. You know, they control the amount of flexible supply in the market. And second, yes, they can bring more flexibility in some ways, but not more transparency, because they are integrated players, so you have no visibility on each cost, individual cost of their value chain. So I think that's two key risks. But otherwise, on the contracting side, I think the development of a secondary market or a third market that we've seen with US LNG has enabled potentially some new players to buy LNG because, if you take a few of the first projects in the US that signed long-term contracts, most of those contracts with Asian players got resold to another player, then again resold to another player. So it's really hard actually to see where some US LNG cargoes would end up, because it's not in the home country that initially signed the contract with some of those US LNG plants. But otherwise, for the new projects that are pre-FIDs, I think banks and the financing component is key also in transforming the contracting. And I think they are becoming more open to the idea of not asking the developers to contract 100% of their supply under long-term contract, but there is more latitude, and they may go ahead and take the FID, final investment decision, with 75% of the volumes under long-term contract, and which means that they have 25% where they can play a little bit and maybe sell it on the spot market. But of course, they have to recover the cost and make sure that they have sufficient money to back the investment decision. So they may be willing to sell first on long term, and then with an expansion they may be also more open and flexible to sell shorter duration. Also, there are some suppliers that are declining, like historical exporters that may not renew their long-term contracts and will open it to the spot market. So there are many different, I think, conditions that make the market like more innovative in a way. There is more innovation around contracting just because there are many different situations, whether it's a new project, whether it's like older projects that don't know what to do with their remaining volumes.
Yeah, no, I mean, 40% of all long-term LNG contracts are going to expire between 2020 and 2030, so it's very much an issue. But to use an oil analogy, like Exxon never built a refinery because they had a long-term gasoline contract. Do you ever think like that in the LNG business we could get to a place, and I'm throwing this out to all of you, we could get to a place where these trains could go ahead without any long-term contracts associated with them?
LNG Canada just did, apparently.
Well,
so
yes.
It's
a leading
might be a
question
way
for you,
forward.
but there you go.
Yeah. But just to go back to the portfolio players, I think this mismatch between buyer requirements and the need to continue to build new LNG plants is actually tilting the playing field in a big way towards portfolio sponsored LNG projects. As we have seen with LNG Canada, they could take a final investment decision essentially without securing any long-term offtake agreements in advance, which is a huge advantage compared to a project which is being developed by an independent developer who needs to sign up to 80-90% of the capacity on a long-term basis and raise project finance that on the basis of those offtake agreements. So I think this indeed might lead to some concentration, but I think we are concerned about market concentration in the hands of portfolio players. I think there is some silver lining. I think this group of companies is a very limited universe. There are only a handful of companies who can actually do this. They have multiple opportunities around the world. They will not buy them all at once. I think many of them, Chevron, Exxon, Shell, they were all burned during the previous cycle in Australia. They ran into huge delays and cost overruns. So I think they will be cautious in jumping into simultaneous development of several of these large greenfield mega projects around the world. So even though I think the portfolio sponsored projects have huge advantages, I think even in spite of this, not all the future supply will be built by this limited number of players around the world. I think we might speculate even about the cyclicality of the market, because if you have a long lead time before you can actually consider taking a final investment decision, that obviously makes the addition of new LNG supply capacity very cyclical, very lumpy. But if you have an easier way to an FID, if you see a little bit of tightening in the market 3, 4, 5 years in advance, maybe the more active role of portfolio players in underwriting future supply might take away some of the cyclicality of the LNG market. This is more of a question than a definitive point, but I'm throwing it out there.
And I think just to add to that, it's interesting to see also that when you look at, if you add the portfolio players in and some of where the growth that we're talking about, the sort of average credit rating of the buyers themselves is actually going down quite a bit. And that does have an impact on the sellers, on how the contracts are re-signed, the length of the contracts. All of those issues are coming in because of the quality of the buyer from a credit perspective has changed from a AAA world to a AA to a BBB minus world, a BBB minus kind of world. And that also, I think, is affecting some of the contracting that we're talking about here. So, all right, I could keep going here, but I wanted to turn this to the audience here. If anybody had any questions for any of our panelists here, this man back here.
Thank you very much. Gabriel Avgerinos, Energy Mentors International, previously with Potent & Partners LNG Consulting. Very, very interesting panel discussion. Sorry I missed the beginning of it. My question is more for a longer-term cycle. You spoke very well about the shorter-term cycles. And just remind ourselves that a couple of decades ago, the US was running around thinking that we're short of natural gas and we're building import LNG terminals, et cetera, et cetera. One of them actually got converted to an export LNG terminal. My thinking here, and the question to you is, shale and fracking, starting in 2005 and then actively becoming bigger and bigger in the United States in 2010, and of course now continuing to grow. Is it conceivable, technically as well as economically, since it's a lot cheaper to take advantage of shale formations than it is to build an LNG import regasification terminal, is it conceivable that within 5 years, and definitely within 10 years, in Asia, more than likely China, you will have shale, fracking, and therefore regional natural gas that's going to be used by China, as well as to start now exporting more regional gas by pipeline from fracked gas? Thank you.
Well, for China, developing domestic resource base is one of the key components of the sustainability of the gas equation. And the three major national oil companies have very strong targets to develop both conventional and non-conventional production in the domestic area. Of course, China is not the United States, and I guess that nothing compares to North America when it comes to E&P in terms of knowledge of the geology, in terms of access to network, in terms of development of the services industry to develop fracking, availability of rigs, availability of water, proppants, everything. So it will take some time for other shale oil and gas resource owners to develop their own industry. This is the case for Argentina, this is the case for China, other countries, Algeria, Russia, talking about shale. But the conditions, having the resources is not the only one. Of course, it's the major component, but you have to have that ecosystem in place to develop that shale. So there are some developments in terms of shale gas in China, but my understanding is that it will take some time before becoming something major.
Yep. They're already producing shale gas.
Yes, yeah. Yes.
But I don't think it will ever displace LNG. I think they need, all the different sources of gas, pipeline, domestic, LNG, because they have so much needs. I think we will see significant production of shale gas in China, but not as much as in the US for sure. They will not repeat like the revolution that we've seen in the US, and again, not enough to become independent, and they would need imports. And there are many different numbers, estimates. They have also issues with water and access to the markets where it's needed. I mean, there are some bottlenecks, but they will manage to alleviate some of those issues. Other markets to watch is Argentina, where they're also developing their unconventional resources. And actually, Argentina just announced that they would release one of their FSRU. In the UK, they've started the first drilling. It's slow, and there will be ups and downs, but there are other markets also to watch for shale gas development, for sure.
Yeah, China is a difficult resource to tap, more difficult than the US, and I understand the resource quality is not quite the same. It's deeper, it's in a mountainous area, it's much more challenging. But on the same time, I think if you look at last year's production data, you can see that the conventional side of Chinese gas production was able to increase production almost 10% last year in response to the supply shortages. So I think there is some scope for further increases in domestic gas production, but that not necessarily will come from shale.
Everything pales in size so much compared to the U.S. that even them getting to 30 BCM, which is I think where they're close to right now, I mean, that would be a lot, in any other universe other than the fact that the U.S. is up to 90, you know? So it's, I'm sorry, 900 BCM, 90 BCF a day. So it's a real apples and oranges kind of comparison. Any other questions here? Yeah, sir.
Actually, France has great.
Do we need to mic it for the let's try and mic this for the.
France has great shale too, but they decided not to. At a recent LNG dinner in New York with a bunch of LNG developers here, one of the topics that came up with some of Trump's global trade policies have actually led to a short-term delay in contract signings, as each country intends to use signing of an LNG contract as their bargaining chip. So sure, I'll do more for the U.S. economy, I'll just sign up an LNG contract. So that's actually delaying contracts into the second quarter, unlike Poland. But other countries are trying to use that as their, like, sure, I'll make you happy kind of thing. Are you seeing any discussion of that in other government agencies, and what are your thoughts on that?
Well, I mean, I think LNG has definitely been used as a tool in trade negotiations, so bilateral trade negotiation, because one of the current administration objective is to reduce the trade deficit, and they've been using, you know, the trade of LNG as a way to reduce deficits with key partners, especially with Asian countries. So I think in Asia, this kind of approach has been more successful, for instance, than in Europe. So, you know, governments in Japan, in South Korea, where actually the bilateral trade deal between the US and South Korea has successfully been renegotiated. India. So there are different countries that have been more, you know, sensitive to this approach and actually willing to go for it. And I think in Europe, on the contrary, it had created a kind of backlash. It depends for which countries, but I think, you know, in general, the politicization of US LNG in the long term may not be the right approach. I think the current US-China trade war has direct, you know, short-term, medium-term, and long-term impact, and depending on how long it will last, we'll be able to see, you know, the damage or what kind of mitigation there will be out of there. But, you know, clearly the signing for new long-term contracts between Chinese company and US LNG project has slowed down and has completely even stopped. Some FIDs for new liquefaction projects have been delayed because they were counting on the Chinese demand to go ahead with the final investment decision. And clearly it benefits rival suppliers to the US, so namely Russia, that, you know, is pushing ahead with a new project in the Arctic, Qatar announcing you know, increase of liquefaction capacity and new liquefaction trains. I would be cautious with those announcements because it's a game, right? Like you make some announcement to preempt other suppliers to go ahead with their projects. So, you know, you're trying to play the game a little bit, you know, and address investors and bankers and buyers. But clearly, you know, in the very short term, we see an increase of Australian supply to China, you know, in the past few months. So, you know, it has an impact.
Just wanted to switch up things just for 1 second here, talk a little bit about the security issues, because we've been talking about the market a lot. And so when you look at the gas value chain, whether it's gas pipelines or upstream, downstream, or LNG, like where do you see like the real risks from a security perspective in terms of the value chain itself? Like where is the IEA kind of focused in terms of, like, let's say the three biggest areas?
That's a big question. Well, it depends on the region that you're looking at. I guess that if I should name three of them, as you suggested, I think that LNG trade used to be a main concern, especially after the great Japanese earthquake in 2011. But the growth in terms of flexibility, mainly with the development of destination-free US LNG, with the development of the portfolio players, has solved some of those concerns, even if on a short-term view you have those seasonal concerns that happen over the last winter and may come back if we still have a tight winter. Shipping within the LNG value chain, shipping has become a concern. I join Leslie's comment on the cyclicity of the shipping industry with a slightly different view on the specificity of the LNG shipping with regards to the bigger segments of shipping, such as oil or bulk or others. We're talking about the very niche markets, 500 vessels, very expensive vessels. An average carrier costs about 200 millions. That's twice the cost of a VLCC. It can carry about a third of the cargo of a VLCC. So we're talking about a very specific niche market, which means that you don't have the dynamics of new builds and scrap that you can see on other segments of the shipping market. So the cyclicity is there, but there will still be some issues in terms of how the ships are financed. That has to evolve in order to make it more liquid. And, well, if I have to pick a third guess, would be underground storage. Okay. With different realities for different markets. Of course, it's not an issue in the United States, not an issue in continental Europe, for instance, even though what we saw at the end of last winter with almost depleted storage capacity and a huge race to fill them during the summer shows that storage is still a key component in the balancing of the markets. But in the case of China, of course, it's a major component.
Does the IEA have a specific view on strategic storage as an option going forward in a lot of these markets in terms of a recommendation?
Well, it's for different reasons, especially technical reasons, it's not the same beast as oil storage.
Oh, of course.
Especially for countries which do not have the geology to have underground storage. Having LNG security storage is something difficult in terms of technical needs and something very costly. So it's difficult to have a one-size-fits-all rule in terms of storage of security stocks. Mm-hmm. So the best, I would say, the best compromise is to have greater diversification of the sources of supply of LNG, but also of other sources, and to have also downstream flexibility. Because one of the components which is key in the development of a global gas market, we've emphasized a lot of the role of the supply side. Of course, it's very important to have flexible and competitive upstream for LNG with destination free. It's important to have flexible and competitive midstream with secondary and third markets. But to have a price signal, you also have to have a price response from the downstream side.
Sure.
And if you look at Asian markets, it's true there have been major efforts done in Japan, in Singapore, in Korea, in China, in India, to have price reforms, to have gradual opening of the markets. But in most of those countries, we are far from having supply and demand setting the price. So, of course, it's easier to say than to achieve. But to have a liquid market, you have to have a price signal on both sides.
I just want to note one item that is conspicuously missing from Jean-Baptiste's list of supply security concern, which is Europe and Russian dependence in Europe, which, if we were 5-6 years ago, all we would be talking about is European dependence on Russian gas supplies. But as I read the report on gas supply security, it looks like this multi-year effort of building an integrated natural gas market in Europe is actually bearing fruit, and if I understand the IEA's position correctly, there aren't major issues with Russian dependence any longer, which is interesting to note, of course.
Fair
We haven't discussed about the trading houses, which I think is an interesting component. Also, when we talk about shipping, because actually recently a trading house seized on the opportunity as Egypt was releasing an FSRU to actually release this FSRU and use it as a conventional ship. But in general, I think, with this trend of how to bring the supply to new, small, less credit-worthy buyers, those trading houses have been taking risks. They've been changing the market a lot those past few years, and I think they will continue to change the market. So maybe something to watch also on the shipping side, as they will try to get into that also.
Any more questions? Yes, sir.
Pepe Banda with Energy Transition New York. My question is on the challenge that you mentioned in one of your first slides on leaks of methane. How significant is that challenge? I read something that is estimated in 0.25% of the production, the total volume of the leaks. That is one question. And the other one is this move towards industrial processes instead of power generation is taking care of that challenge?
So, this is a topic that has been addressed, partially addressed in last year's issue of the World Energy Outlook, on the more longer-term perspective of focusing on methane emissions from exploration and production. It's true that there is a point to which the positive contribution of natural gas versus other sources of fossil fuels could be challenged depending on that. To be fully honest with you, I don't have in mind the figures from the report, but this is a topic which is gaining momentum, raising awareness on that, and major gas producers have taken the pledge to reduce their methane emissions from production. This being said, it's difficult to map in most of the producing and exporting countries where metering and overall exploration and production conditions are less transparent. So it's difficult for me to give you a precise figure for that. But it's true that the premium, the environmental premium of gas is not unlimited. There are some counterparts that have to be taken care of, and leakage is one of them.
And flaring? Is that an issue? Or, I mean, obviously it's an issue, but
yeah, it's an issue.
I guess as the price of oil gets higher and the price of gas gets lower relative to oil, the incentive to flare becomes greater, or the need almost to flare becomes greater for a wet gas field. I mean,
absolutely, yes. It's also linked to the monetization of those different resources, availability and access to a collection network to bring them to end users or to reinject them in other fields.
So for flaring, actually, there is one good news is that there is increasingly more data transparency and no way to hide anymore because of satellites. So I think it will necessarily force producers to actually curb and cut all this flaring because everybody knows about it now.
So to switch to pricing for a quick moment, on your slides where you were showing sort of the level of most LNG long-term contracts are oil indexed. We have some spot indexation that's certainly emerging. As we see these older legacy oil index contracts roll off, do you think that we're going to see more of a switch towards spot indexation, or are we going to have some hybrid between the two sort of pricing philosophies, and sort of where you think the direction of this is going?
Well, that's a several $100 billion question, to which I'd be happy to answer if I had the answer. Well, I think that as those legacy contracts will expire in the next 5 to 10 years, several options will be on the table for producers on whether, to which extent they renew them or get some more flexibility for short-term trade as the short-term trade market expands to optimize and get some potential revenues from that. And if they want to renew, what would be the conditions? And it's true that, well, in Europe it's already the case. Asia is increasingly pushing for, if not hub indexation, at least hybrid indexation. But as in most of those issues, it also results to a chicken and egg issue, because in Asia you need to have a local hub to index against, because having hybrid is a good option, but I'm not sure that Asian buyers will be happy to be linked to supply and demand conditions happening in the UK or in the US or in the European continent.
Sure.
So having a basket of different indexation is one of the solutions before having the eventual development of local, regional hub indexations.
Okay. You thought about this, I know.
Yeah, I think to a certain extent this can ebb and flow. Obviously, while Asian prices were $16 per MMBTU and US prices were around 4 or 5, this huge price gap made Henry Hub indexation an obvious and rational choice and very attractive in the eyes of Asian buyers. And then for a certain period of time, all these Henry Hub index contracts were underwater. On a full cost basis, they were losing money. So that obviously took away the or reduced the attractiveness of Henry Hub indexation for some time. And now that oil prices are edging back up and Henry Hub stays relatively low, I think the attraction of Henry Hub index contracts might actually return. So what Asian buyers especially desire is the lowest possible prices, and when they see Henry Hub indexation delivering that, then they might sign up for more volumes. But obviously there are basis risks involved. So to a certain extent you'll have to be able to hedge your risks when you sign up for one index and your market fundamentals are actually not connected to the US domestic market. So I think there will be some role again for intermediaries, portfolio players to intermediate this trade, have a portfolio of various indices and serve buyers which might have specific needs for specific types of price indexation.
So one more question, Jean-Baptiste, for you is that in your forecast, where do you see potentially the greatest area of risk in your forecast? Where is there the area where we go, oh, yeah, maybe this isn't going to go as planned? I mean, is there a specific area that is, or are you fairly confident that it's sort of balanced across the entire supply-demand fundamentals of what we're looking at here?
Well, to be honest with you, there's several areas of uncertainty, but I won't give you all the answers for sure. I could barely answer saying that markets will be balanced anyway, so it's just a question of supply and demand and prices. But again, I think that the main uncertainty is to which extent emerging Asian markets will develop and will adapt to be more resilient to price changes.
Leslie, Akos, when you were looking at the presentation, what did you feel about the same question in terms of risk to the forecast?
Well, I agree with US LNG being a big component of the growth of supply. There are different risks on the US LNG side. We discussed a little bit the US-China trade war. By the way, everything can be reversed very fast if there is no more war tomorrow, but nobody knows how long it will last. But beyond that, I think on the demand side, the key for me is going to be financing the infrastructure that is needed, and who is going to finance it, and how long would it take to build those necessary infrastructure. We haven't discussed the growth of LNG as a bunkering fuel, but that's also a place that suppliers are targeting and looking at how much demand there will be. post-2020 when the IMO is bringing those more stringent regulation for sulfur emission in the shipping industry. But beyond that, 2025. But there are also, potential risks to this outlook in terms of the price of the competitive fuels, and also whether the industry is going to be convinced that LNG is the fuel for this transition. So that's, I think that's not just for the bunkering, but in general, this idea of transition toward a lower carbon economy, and whether gas will have a role to play. I think in general that's the key, risk, and yeah.
All great points. I agree with most of this. Yeah. So I think the demand side is always uncertain, especially these days. I think there are also huge uncertainties about the supply-demand balance itself. Just a few years ago, we were expecting a huge glut to hit the market. That, of course, never happened. Some people say it still might appear in the next few years, and then we are entering into a growing supply gap and very tight markets. Potentially, people are not able to build enough capacity fast enough to come to the market. But these things have a tendency to be able to change very, very rapidly, and it's part of it is because it's so much policy driven, especially on the demand side, that it makes these moving parts to a certain degree unpredictable. And I agree that political risks and this whole trade war scenario is potentially making life more difficult and more complex for those who rely on a liquid, flexible global market increasingly on the LNG side.
It is amazing how, given that most of the infrastructure associated with LNG takes 2 to 4 years to build, how quickly things can change, even though we know it takes 2 to 4 years to build things. So it's kind of it can be kind of confusing sometimes in that way. Are there any more questions that we have here? Yeah, here, and they're here.
I'm Frank Naidu from South Africa. We're about to award licenses to Shell. I think I want to revert to the methane leakage question, because I think that's critical. When in a climate change discourse, you try to balance the fact that shale is clean burning. There's always the topic that comes up about methane, and there's no ways that one can actually balance that discussion. So you say that there are measures that are in place. What are these measures, and what time frame do you give that we could look forward to and try and balance that debate?
Excuse me, could you I didn't get the beginning of your question. Could you please say again?
My question is about the methane leakage.
Yes.
You said that there are measures in place to actually get around that. My question is, what are these measures, and when will they actually be available, where we can arrive at some kind of quantification regarding for X amount of shale that is being extracted, what is the emissions of methane? And also, to balance that debate is to try and do a comparison to see how much of methane is coming from agriculture versus shale, because that's a really hot topic, and I think it might have been dealt with in the States, but in developing markets, those are one of the critical arguments that we face, especially when we're talking to the environmentalists.
True. So on the agricultural side, I'm afraid I don't have much information to... Yes. On the measures to mitigate shale and to leakage, and how to incentivize that. Well, I encourage you to go to the special outlook that was made last year in the World Energy Outlook, because in this report, the authors have provided an abatement curve of all the different measures. And the good news is that most of these measures come at a negative cost. So, in fact, to put it simply, it would be positive for the industry in terms of revenue to put in place most of those measures. It's just, it's simple controlling of infrastructure environment and wielding and all the casing issues that are similar to oil production. So this is not something, I mean, unreachable. Of course, the magnitude of the network and of all the infrastructure already in place is a challenge by itself. But the cost of mitigating those leakages, in most cases, according to the survey that's been made, is negative. So there's a positive outcome for the industry.
One last question.
Thank you for this very interesting conversation. I have a short question. Does the price of LNG depends on what gas it is produced? I mean, from shale gas or conventional gas? And what gas is used for production of American LNG? Thank you.
Well, in the US network, there is so much blending of the different sources. It would be difficult to trace the origin of the production. Of course, if you take a proportional measure, the share of shale gas increasing, there's an increasing chance that your LNG would come from shale gas. In the end, the pricing benchmark is around the Henry Hub, which is the most liquid hub in the United States. But it's difficult to say that your molecule will be sourced from this basin or this basin. Again, in terms of proportion, there's a higher chance that there would be shale gas in it. But as long as you have an interconnected network, it's difficult to trace the molecule.
It was interesting, a few weeks ago, there was a contract signed between, I believe it was Southwestern Energy and a New Jersey utility with what they deemed as something called responsible gas, which was like the first time I had really seen sort of ESG-based principles in terms of looking at the actual value of the gas. So from an ESG perspective, it was quite a change in the market. Now I'm curious to see if that's going to develop more in terms of, you know, the shale production versus conventional gas production and what that means. So it is kind of interesting. So as I mentioned before, there's a full video recording of this event will be available on our website in the next few days. You can also subscribe to the podcast series on iTunes, Stitcher, SoundCloud, and other platforms. Just to announce the next event that we're having here will be on November 14th between 6 and 7:30. The event is called Triple Access, Iran's Relations with Russia and China by Dina Esfandiari and Ariane Tabatabai. And it's part of a book launch that they will be having. So I hope to see you soon, and thank you all for coming. And if you do have any questions afterwards for any of us, please do ask us. Thank you very much.